everybody, and welcome to the Wall Street Report. I'm Jennifer Schonberger. The story dominating the ticker tape is the Federal Reserve. The Fed said it could start dialing back its bond purchases later this year and end them altogether by the middle of 2014 if the economy picks up. Ever since the Fed statement, markets are having a conniption fit. The central bank has become entrenched in the Treasury and mortgage-backed securities markets because of its pervasive trillions of dollars worth of purchases. When the Fed does begin to curb its purchases, it will be a messy process. We're getting a preview of that now in anticipation of it happening. It's like weaning a drug addict off narcotics. There will be shakes and cold sweats with repercussions across asset classes, from bond yields to mortgage rates and stock prices. Volatility will rule the day. Bond yields and stocks will rise and fall as prices adjust to a world with less stimulus. But before you conjure up nightmares of the stock market crash of 2008, step back from the headlines and the noise. This is healthy. It's something I've been calling for months. It's unclear the Fed's bond purchases are helping the economy any longer. Quantitative easing is simply funneling excess money into markets, driving stock prices far ahead of the strength of the economy. The fact is, asset prices are being manipulated instead of reflecting the true health of corporations or supply and demand for securities. In fact, the Fed pulling back can actually clear the way for the economy to move forward. Here's how. First, quantitative easing took pressure off Congress to implement reforms needed to trigger real growth in the economy. Pulling back monetary stimulus should finally force the government to undertake policies to boost growth. Congress won't act otherwise. Second, if the Fed were to start tapering its bond purchases, it would unlock credit, the oxygen of any economy. That would free up trillions of dollars in treasuries, which financial firms use as collateral for short-term loans to Main Street for everything from mortgages and credit cards to business inventories and drilling projects. Traditional banks would be more apt to lend as well. Zero interest rates and purchases of treasuries and mortgage-backed securities pushed long-term interest rates lower. That squished banks' profits earned on the difference between what it pays on deposits and the interest it gets on loans. In many cases, low profits on loans discouraged banks from lending. Bottom line, scaling back quantitative easing is a step toward returning to normal, and one that could unlock economic growth.